Thanks very much. Welcome back after lunch, everybody. You're feeling satisfied after those pork pies. Good to have you all here. Well, we've put together, I think, a pretty good panel for you today, especially the range of type of investors on the panel today. So I'm just going to introduce them one by one. So first of all, on the far left, we've got Hans-Arne, who is with Clarksons Platou Securities, which is an investment bank based in New York and Oslo. So you've got the investment banker at the end. Then we've got Phil Clegg from Orion, who you probably mostly know from the private equity side. Then we have Richard Shemesian from Bennelong Venture Capital out of Australia. Richard is more on the venture capital side, so some of the kind of smaller investments. And then last but not least, we have Adam Howard from the EBRD, much more kind of government-backed financing. So a really interesting range of potential investment for the junior market here. So before we kick off, I'm just going to ask each of the individuals to just give two minutes each on their type of kind of favoured investment, what they're looking for in this market, and maybe just a little bit about their corporation. So if we can start from left to right, Hans-Arne.
Yeah, good afternoon, everyone. Representing Clarksons Platou Securities. We are an investment bank specialized for the cyclical industries, shipping, oil and gas and those services, and metals and mining. And certainly 80% of our services is about 50-50 split by raising equity and debt and structured debt for mining companies. The last 20% is M&A or M&A related services. What we do see really, and I want to bring to the table today, is that it have changed for all the junior companies to the threshold for raising equity. There is plenty of credits out there. There is plenty of alternatives that my colleagues will come back to. But the threshold for raising equity and how to do that is probably the largest sort of threshold to get financing in these days.
Hi everyone, I'm from Orion. Orion is one of the largest providers of private equity finance to the mining space. We currently have about $5 billion US under management. We exclusively invest in mining. We're about 50 people globally with offices in New York, London, Denver, and Sydney. But I use the word private equity in the loosest form of the word. It's not just equity that we do. We invest across the capital structure. And if you were to look at our portfolio as a whole, you'd probably find about a third of our investments in senior debt, a third of our investments in product-linked instruments such as streams, royalties, and offtakes, and a third in equity. And we do all sorts of deals in that, in those structures, including things like construction finance packages, where our counterparts can select different parts of those structures for the financing structure for their construction. And we do other things such as M&A finance, including things like take privates, MBOs, and M&A financing structures for management teams that want to take their company private. So that's what we do.
Hi everyone, my name is Richard Shemesian from Bennelong. We're specialising in venture capital and pure private equity. We target the sub 50 million market cap. I think that's where the opportunity lies at the moment when the markets are down. We're looking for several times investment sort of returns, high risk, high reward. We're looking at ASX, AIM and also TSX companies like to take significant equity positions but also help management with board roles as well. So we try and help the companies through the process, not just passive investments. I think we'll see some slides shortly about why there is opportunities here, but I think that's the neglected part of the market, which there's now alternative forms of equity finance rather than IPOs at the moment.
Hi, my name is Adam Howard, joining from the EBRD. EBRD is a development bank where we're operating in just over 30 countries, and we're owned by just over 60 governments in Europe and outside of Europe. In the mining sector, we invest just over $500 million a year, and about 3/4 of that is debt, increasingly doing more in the equity and alternative space. And in that area, we typically look at investments between 10 and 100 million. Long-term finance, where we're looking at projects post-pre-fee stage.
Okay, thanks guys for that. So I think everyone realises that the equity markets at the moment are suffering. I think Australia's had a bit of fillip at the beginning of the year, but is still pretty down. Canada, we know, is really struggling. It's interesting, we've got a lot of Canadian companies here today, and we know the effect that things like the cannabis market is having in Canada. I hate to disappoint you, but it is starting to emerge in the UK as well. We are starting to see some medicinal cannabis companies out there, but I don't think they're going to take away your capital here in the UK. It's far too early for that, so don't worry. But certainly things have suffered. We were going to put up a quick slide, if the gentleman at the back put that back up. This was something, Richard, you wanted to talk about this is the ASX companies that have come to market in the last year and how they've fared. And maybe off the back of that, Richard, you could give a little bit of commentary about what's happening with the Australian capital markets.
I mean, yeah, I think everyone knows the state of the market, but interestingly, Australia was the better market last year to raise capital, 768 million in IPOs, over 30 companies. But obviously only 3 of those companies take up 80% of the fundraising. One was a fund, Tribeca and Nickel Mines. So take that out. You've got 3 companies that have outperformed. This year, 3 floats. So ASX is now sort of following TSX, the name, in terms of IPO. So companies now need to look at different ways of raising money. Interestingly, the 3 that have outperformed, if you look at Adriatic Metals, good management team, people have backed it, and a very interesting zinc-based metals project, 300% return. Constellation, again, backed by, we put money into that, it was backed by Ian Middlemiss. It's a cash shell, effectively. And Nickel Mines. So there's some similarities in terms of why those companies have outperformed. You've got to have a good management team and a good story if you're going to go to market right now. But I think these guys will also be able to chip in and say what are the other ways of raising money, and there's some interesting examples we can talk about later for junior companies.
So if the equity markets aren't there, where is the money sitting? Who's got it, and on what terms are they giving it? Maybe we can just run through the panel on that question. Phil, do you want to start? You've got all the money.
Yeah, I mean, the equity markets is a huge problem right now, and actually I would say that people often come to us and say, why do you care? This is easy for you, you're mopping up. But it doesn't work like that. There are pros and cons, and I think there are probably more cons. And so if you think about a construction financing situation, you can have a private equity firm such as Orion there for your debt, for your stream, for your off-take, and then for a big lead order on the equity. And so we could do, say, 75, 80% of it. So the company's got every chance of getting the fully funded financing solution to build a project. But that residual 20, 25% we cannot do. That has to come from somewhere else. There has to be a buffer. There has to be another investor there, or suite of other investors. And it's that's the challenge. On top of that, most of our equity positions are in publicly traded companies. And that's useless unless you can exit. So you need a properly functioning equity market in order to be successful as a private equity firm. Now, there are pros, as I said previously, and the thing that I would point to as associated with that would be the opportunities that we see for M&A, right? So you may have seen the Dalradian deal that we did last year, which was a take-private situation. It was effectively an MBO, but backed by Orion. We did that transaction because the equity markets were dysfunctional, could remain dysfunctional actually, and so it presented some exceptional value upside for us in an asset in a jurisdiction that was not properly understood. So yeah, it's mainly challenging, but there are some interesting opportunities there. And we're seeing actually, even in bigger companies right now, there are opportunities to take advantage of that by engaging in carve-out situations, for example, as well as other forms of M&A.
Hans-Arne, where are you seeing the alternative funding coming from?
Yeah, what we're really seeing, and there is a slide there, I don't know if you have included it, which names that used to provide the equity capital for junior miners and so on, and where the money is now. And I do believe that a lot of junior miners should be less focused on being listed, whatever it's AIM or ASX or TSX, and rather sort of get private equity or funding from larger mining companies. They really have a lot of capital in these days. They are searching for new projects and development. Due to that, they have returned so much capital to their shareholders. They have done dividends, they have done buybacks, and they also reduced their debt to a very low level. It is that way that to get money from the equity market today, you need to have a market cap, you need to do a transaction of reach and size, and you need to have a liquidity. If not, the traditional equity investors is not willing to take even the meeting to listen to your story because they don't do the work if they cannot write a larger ticket. So I think that being private or being supported by a larger major mining company or by gentlemen like Philip is the way to go, and to wait and hold back on your listing until you have a certain size.
I think that's a good point, but unfortunately, most of the people here are public companies, so you have to raise money from the market. So I think the sort of people that you have to approach are private equity guys, but you're a public company, and those guys have to be realistic. You have to target the guys who've got a 5-year or 3 to 5 year horizon, especially if in that exploration and feasibility. So target your investors. The people that we're seeing putting money into sovereign wealth funds, like the Armani group, I think someone mentioned SGRF, family offices are putting money in, private high net worth individuals. These are the 3 key areas that the market is open for, but it's tapping in those guys who understand your time frame. So effectively it is private equity, but you're publicly listed, and just targeting those guys. And we tap into those sort of guys, so it's finding the right people that can introduce you to those investors. Going to a broking firm today, if you ask me, I'm sorry if the brokers are here, it's a complete waste of time because they just don't have the client base, and all these regulations and rules is making it hard for them to invest in those junior companies. But there's money out there. You just have to go and find the high net worth guys that have understand the risks. So it's out there if you've got a good story and a good project.
I think, as you say, there's less capital available in the public markets for short-term capital, and there's more capital available from alternative providers like ourselves and the private equity funds looking at long-term capital. I think there is a different way that ourselves think when we look at projects. We finance very much on a project basis. We need to see it fully funded. And in the public markets, typically you come back each time you can at a higher valuation to raise that money. So there is a different way, the way we approach projects and the public markets do. But we are very much in the market and financing mining projects, and have been fairly active over the last couple of years.
Is the truth really that for a lot of these projects, if you want to raise the type of capital you need, you've actually got to get a mixture of financing? And if that's right, is there one mix that works better than another? Private equity and the capital markets, or a strategic investor, convertibles? What's the kind of ideal type of mix in a project, or does that very much depend on the type of project it is?
So from our perspective, you just have to have a huge amount of flexibility. And one of the successes behind Orion is an ability to tailor the financing solution to the counterpart. And so many different things will drive that. If you look at the project economics, for example, sometimes you have projects which have very long construction periods. Sometimes you have projects which do not. Sometimes you have projects which are in commodities which can attract strategic investors or off-takers. Sometimes you do not. So you very much have to tailor it to the individual circumstance. But the one thing that I've noticed actually over the last few years in the markets that we play in, which is all of the markets, is that the debt side of what we do has become more competitive. There are an increasing number of private lenders. We have seen the banks come into some deals, very high quality deals, and we've seen in some deals the Nordic bonds come in to construction finance as well. And so what we've had to do as an organisation is to evolve to that changing market and continue to tailor our individual financing solution to the fact that other forms of capital are available. So the key thing from my perspective is that building a mine and financing the construction of that mine is no way cookie cutter. You can't say there is a best way to do it. You must tailor the financing solution to the individual circumstance.
Yeah, certainly we have done several project financing through what's named sort of the Nordic bond market, where we really tailor-made the cash flow from the project to the installment and repayment period of the bond. And the bonds really have been very well received, both in Europe, particularly London, but also Scandinavia and Central Europe. For larger projects, we've seen that is also very well received in Hong Kong and Singapore, and as well in the US, if size is north of 250 million for a senior secured. But the Nordic bond market offer an excellent opportunity to tailor-made a senior secured financing where banks not are available. And I think this goes a bit with what Philip is saying as well, that the total capital costs have been moving upwards. There is relatively few projects that can get development financing by a bank on the traditional 500 to 700 basis point over LIBOR. This is more sort of the 9 to 12% cost of capital.
Adam, what's your view on the debt financing side?
So we operate across the capital structure. So we'll do debt financing, we'll do convertible and mezzanine, and we'll do straight equity. We tend not to do them all at the same time. And I'd say at the moment, we've been focusing more on convertible financing. That's partly a reflection of the fact that liquidity is not great in the markets. So that gives us an alternative exit if that liquidity does not come back. But we'll work across the product suite on capital structures.
And I mean, if you look at the Canadian market, the concepts of royalties and streams are very well developed concepts. We don't see as many of those, or certainly I don't see as many of those here in the UK. Is there a reason for that, or is the demand for the royalty and streaming model over here?
Yeah, we do a lot of royalties and streams. I think you probably think of us as rather than a London organisation, probably a New York organisation, as opposed to a Canadian organisation. I think that you need to distinguish the royalty and streaming market in between precious metals and non-precious metals. So the precious metal side of the streaming market is very, very Canadian focused, with companies such as Franco and Royal Gold and Sandstorm and Precious Wheaton. And these guys have an exceptionally low cost of capital, and so can offer streams and royalties to gold and silver companies and companies that have byproducts in those metals pretty well and pretty competitively. What they don't do is really offer royalties and streams to companies that don't have those metals. So we're seeing, and we are actually ourselves, very interested in providing a royalty and streaming solutions to companies that are base metal producers, and even into some of the industrial minerals. So think of things that have like great annuities, like things that long mine life assets, like in industrial minerals, things like mineral sands and the bulks and some fertilizers and that kind of stuff, some minor metals. That area hasn't really been tested with sort of big dollar transactions. And we actually raised a new fund last summer specifically for that, looking for long life royalty and stream investments in construction-ready projects. So we think that area is quite exciting, and I have to say that we see more activity in that side of things outside of Canada, in London, and some in Australia as well.
It's interesting, everyone focuses that can get those royalties for those production stories, but also I saw recently on the TSX, I suppose because they're more used to royalty companies, but there's some in Australia as well, a company called LithoQuest, a little 10 million market cap company, to attract the equity investment, not a lot of money, they attached the royalties. So raising 1.5 million plus an interest, a 1% royalty interest, which I found very interesting. So if you're an equity investor, you also get a piece of the royalty as well. So I think for the guys raising equity, think about also giving the investors a little bit more as well, especially in this market. You'd be surprised which investors might come out and want to invest and target the royalty companies and your equity investors at the same time. So you get a share plus a part of the royalty as well in your project. And we're talking about early stage here, pre-resource. But if you've got a resource, you might even attract some investors by attaching a royalty. If you're interested in that, happy to have a chat with some people about that sort of structure.
That's pretty novel. That's I'm not sure I want to do the paperwork on that one, but it sounds fascinating, that one, because normally you'd see a warrant attached or something else, but actually attaching a part of a royalty as well. Maybe I can ask, apart from the royalty streaming, what other types of alternative financing any of the panels seeing at the moment they think is emerging in this currently difficult market? Anyone want to offer? What about the, we mentioned M&A, and clearly it's not a form of financing directly, but when you do a merger, there's a growth story there. And as you said, it's pretty key now to be large to get into the generalist investors, for those passive investment funds to take notice of you. How large is large? How big do you have to be to attract that type of money?
I'll first start and say that we have taken on a convertible team, and there are some special tailor-made. There is not a lot, but there is relatively large amounts behind them that could do club deals on convertible debt for development and junior companies. So that's one avenue. From the M&A part, we really do see that M&A amongst smaller companies not be taken out by the big one. We think that the threshold is really to get at a minimum north of 200 million US in market cap. But probably, if you really want to get access to the whole sort of range of capital, to the full structure, you probably need to be north of 500 million in market cap, as long as you are certainly a listed company. So if you want to go there, you'd rather have been backed by someone to increase your capital and ability to execute M&As. Or if there are 2 or 3 juniors, you should really take not fighting for being the king, but making a company big enough to achieve financing with the full capital structure. So there's 2 avenues. It's rather being backed, fill up with cash and buy someone, or go together and not fight being the CEO in a small company without financing.
Yeah, I mean, the other thing that we've seen recently in some of the more strategic metals, so here think really battery materials, maybe a bit of copper, is the ability to bring in a strategic investor. Started to see a little bit in the sort of toehold positions that gold companies had taken, but now it seems to be a bit more in the sort of battery materials, and particularly in lithium, where you've basically got Asian battery manufacturers taking direct stakes in lithium projects, sometimes pretty early stage projects, in JV structures in return for getting guaranteed offtake. That if you're operating in that space, seems like quite a neat way of raising capital, because effectively what you do is circumvent your share price and get more fundamental value for the project.
Yeah, certainly. I don't know if anyone saw the announcement this morning by Bacanora. So they've got Ganfeng Lithium. They've signed a heads of terms with them where they're coming in at 29% stake in the topco, but also taking a 22% at the project level, which is the type of, I guess, arrangement we're talking about with an offtake attached to that.
I didn't even know about that one, so.
Yeah,
Charles, I mean, the Chinese are used to these sort of deals. We were in Germany a few years ago, and they're all talking about, rare earths is running out, and we went to BMW and Mercedes, and they said, yep, we definitely want to finance a mine in Australia. I mean, they're not going to. They weren't going to put money into a mine. BMW doesn't want to be attached to a dirty mine in Australia. But I was just told recently Tesla and Ford are now looking at investing in mining projects. I mean, we just need one of these Western companies to help fund these mining projects. But it's taken a long time. The Chinese are always there, but you never get these German companies or the Western companies investing in mining projects. If we start to see that, that'll be a great new form of financing, but I haven't seen too many of those being pulled off. It's Chinese always.
Yeah, why are the Europeans so slow at taking that?
They don't want to. BMW's major shareholder, some woman in Germany, she doesn't want to be involved in some mining problem down in some part of Africa or Australia. But hopefully they'll change their mind, because without that funding, you can't get to see Orion until you've actually got a bit of funding from a strategic investor. So we're in a catch-22 position. Everyone's sort of saying, come and see us when you've got a mine, but who's going to fund it from exploration to feasibility? There's going to be there's a big gap there, and I think hopefully that'll push the metal prices up, because there'll be a lack of new mines coming up. So maybe it's a good thing, but it's a bad thing at the moment.
Okay. Sorry. The last query was just really around matching your finance requirements for your mine to what's available in the market. Do the panel think that essentially, if you're looking, when you're doing a feasibility study, etc., you should be looking for smaller projects on the basis that it's going to be harder in the next couple of years to raise that? Should you match your project to the money available, or should you just try and raise as much as you possibly can on a larger project?
I really think it's a bit opposite. You need to do exploration and do enough exploration to have a sizable project. I think it's to downsize projects and have small projects to go to the market is even more difficult. Mm-hmm. So I think necessary exploration to take them to a decent size and decent lifetime is necessary to get financing. So I cannot recommend companies to downsize projects to believe that that will be easier to finance.
So it's a really tricky one, in my view, because it depends on the objectives of the management team. Sometimes management teams just want to stay solo, they want to stay in the public markets, and therefore, from that perspective, they're only going to raise money from the public markets and from private equity. You can't go too big, right? I mean, we can go quite big, but as a general rule, you can't go too big. And so we see situations where teams tinker with the project. So they'll, go for the high-grade core and then just push some of the capex to a second phase, maybe increase sustaining capital. And I can understand why these guys would do that. But the exciting projects are the big ones, right? And I think that if you're going to attract the, M&A suitors, for example, some of the sort of mid-caps and majors, that you have to put your foot down, like Hans-Arne says, and go for the bigger project.
I think if you've got $1 billion in front of your capex, it's going to be tough. So you've got to be sub that to get some traction, because you have to still raise the equity. These guys are not going to lend you the money unless you can raise the equity. So you've got to have a smaller sort of capex so that you can actually raise the money. They're still going to ask you to go and raise the money in the equity market. So it's got to be a reasonable size, not too large.
I think it depends on the project, I think is the answer to that. But I mean, we like phase projects that are rolled out and that sort of slowly de-risk it over time. But maybe the pendulum sort of swung the other way on this. So 5-6 years ago, you'd meet the 50 million market cap company that wants $1 billion to build their mine, and now it's the opposite, where a lot of companies recognise the change in the capital market, so come with very small projects when a little bit more drilling would really make it more attractive. I think it depends on the project, but probably the pendulum has moved on this.
Okay. So we've got a couple of minutes. So if anyone got any questions from the floor for the panel, we've got 2 or 3 minutes left. Gentleman over here. So there's a mic coming.
Hello. Yeah. Richard sort of touched on it, and it's just a bit of a general question for all the panel, really. But the fact that it's very difficult to raise financing for junior and mid-cap companies, at the same time, the major resource companies are basically self-constrained with respect to their own investment. In fact, have not really made big investments in the industry for a while. Do you think, as a panel, or as individuals within the panel, that's beginning to have an impact on the long-run outlook for not projects, but so much for the commodities that it's such that if you're not getting the investment now and haven't had it for probably 5 and maybe you could say 10 years, the big investment that's been normally gone on with these things on an ongoing basis, is that creating a problem, do you think, as a group, for the world going forward? Because if you don't get the financing and the big guys aren't investing, well, we're still consuming. Okay, we can worry about Mr. Tweet, but we are still, as a group, as a world, investing. But what's happening underneath? Are we going to run into Are we starting to run into a problem yet?
We definitively moving into an undercapitalized, underinvested industry. I think we have seen it as an example with the fatality of Vale in Brazil. We have seen it in the oil industry, and we also see it in different sort of base metals and industry metals like met coal. We think that in general the capex level from the sector in total, being the majors plus juniors and their ability to raise external financing, will be a squeeze on different sort of the commodities long term. But I still believe that this is 2-3 years down the road. But the Australians have shown, as we did see post-April 16, where lithium prices technically moved from 7 to 15 and even to 25,000 ton, there is relatively few places in the world that is as good as the Australians to get mines up and running very fast to meet that demand. So, and at that time you did see capital were available. So yes, it's a problem. It will make squeeze on different commodities, and at that time, capital markets will offer the capital to the super profit.
Yeah, I think that's a good point. I think this is a great opportunity to get some companies that have got good projects, because it's only going to take one thing to make that price pop, and we're seeing it in iron ore. We're starting to see money flow back into some junior companies in Australia for iron ore. Who would have thought iron ore would have been, at nearly $100 US? Cobalt smashed. Now, again, something happens in DRC, that cobalt price will move. I think you've got to be positioned. Uranium's another one, but a little bit different, because obviously some of those projects will be turned back on very quickly. But I think it's going to come to a point where these prices will go up, because there's just not enough new mine supply coming out. I think it's a major issue. Whether it happens in a year's time or 5 years' time, we don't know. But it's a great opportunity now to pick up some of those companies that have been, really hammered. I think this is a great time for looking at projects. Okay, we're out of time, but the panel are available if anyone wants to again talk to them individually. So just remain to say thank you very much to our guys. Hans-Arne, thank you.